Welcome back to the Permissionless podcast, of course, brought to you by the team at Guardian. And as always, we're going deep with DeFi builders, folks who are building on the edge, introducing a new product in the DeFi space. And I think we are upholding that mission today with the team from Zivoe, which is bringing a new type of access to loans that otherwise was totally not available in the existing DeFi marketplace, and it's totally orthogonal to all of the different borrow lending opportunities and different yield opportunities in general in DeFi. And this is access to consumer credit. So we're going to let the Zivoe team go much deeper into what that actually entails, but essentially it's a source of yield that is not involved with anybody who's already lending or borrowing on chain or anything like this. They're actually bridging capital that's on chain to be able to use by consumers in the real world who might not even have any idea where the capital is coming from on chain, and they don't use DeFi at all. So we'll let the Zivoe team go much deeper into all the complexities and integrations across the stack that need to happen and make this occur. And then even look at the risk and opportunity in the risk-adjusted yields for what they're building here, and look at the scalability and discuss a little bit about how this will impact DeFi and ecosystems going forward. But of course, before we get into that, my name is Owen, and almost 4 years ago at this point, I co-founded Guardian, and we set out on the premise that DeFi would house hundreds of billions and trillions of dollars of the global financial system on chain, and that we would need a standard of security assurance that was a stepwise jump higher than what was available for institutions to be able to come in and build the products that they ultimately want to. And today, I'm happy to share that we have achieved this standard necessary at Guardian. We use multiple auditing teams on every audit. We use some of the most advanced fuzzing techniques in the industry, and we use some of the best security researchers in the world to achieve a level of security assurance that is so high that we're able to put up our own funds as a bounty on the contracts on behalf of our clients. And with this level of security assurance and confidence, really it's just a matter of time for DeFi to catch up. And now, of course, with all that out of the way, let us get into this conversation with John and Thor from Zivoe. Awesome. Well, I mean, first of all, dude, Thor and John, thank you guys so much for taking the time to hop on and discuss with us today. I'd love to get to, before we even get into everything you guys are building today at Zivoe and some of the new stuff that you're working on, I'd love to go back and let's understand like the context of how did you guys even come into DeFi in the first place? And I mean, maybe we can follow that line and see where you guys got to this opportunity today. But how'd you guys even get into crypto blockchain those years ago?
John, why don't you take this to begin with?
Yeah. The way I actually got into developing in crypto was kind of a crapshoot, actually. So senior year, ASU, Arizona State University, you do this capstone project, which goes for the whole year. And I had initially been assigned to a project that was for U-Haul. And it was like to design this new app for U-Haul, which is, by the way, I think one of the largest companies in Arizona, and like the two richest founders, the brothers out here.
Oh, they're based in Arizona.
Yeah, they're based in AZ.
Oh, cool.
I know they're watering hole. I won't disclose it, but so at any rate, I was assigned to that project, and by some sheer luck, someone wanted to join from a different one, and I said, well, I'm not really married to this, so like if there's something else out there, I'm happy to take it. And I ended up joining a different group, and we were assigned this ticketing application using Ethereum, which was a phenomenal opportunity because what ended up happening was I did kind of the smart contracts on Ethereum to do the ticketing side, then got into the front end development, and then also like the biz dev and networking side, and going out and actually saying, hey, now you got a crypto product. How do you actually launch it in the real world? And so you kind of need all two or three components of those to have a successful project and to get it out there and be useful. That turned into me talking with like the head of ticketing at ASU. Turns out they have like this ironclad contract with Ticketmaster, which can't be broken like for decades or however long. maybe that was like, I don't know, it was like 7 or 8 years ago. So maybe it's coming up now, the 10-year contract or
No,
something
no
like
idea.
that. Ended up then finding this company called Aventus at the time. They were trying to get into ticketing. It's really cool because they had raised like 3 million in ETH. And like as I was talking to them and over like the 6 to 8 months that we were working together on this, because I was actually trying to get them to use some of their stuff and see if we could get it working at ASU. Their 3 million in ETH had somehow ballooned to like 29 million in ETH. It was a crazy time. They raised in ETH, so it just
Right.
skyrocketed. And they ended up having so much money that they didn't know what to do. And they started out branching to different products and services and expanded their reach. And so that was like how I got into crypto to begin with. And I've worked on like a vast array of projects from there. I'm just really fascinated by decentralized technologies in general. So I started working on like IP with IPFS, like decentralized file storage, understanding the value there, deduplication of similar files, doing private networks so people can get that value, but still have like private sharing of files. Let's see, NFT projects. There was a small project out of Australia called Zed Run that they were doing these NFT horses, and I came in and I said, well, guys, you got to do betting too, because with smart contracts, we can implement the paramutable wagering side of things and have everything handled on chain, the accounting side. Then ended up working at Maple Finance for like the early, like a year and a half. I worked very closely with Sid and Joe and this very small team to evolve the product. We can get into that later. It's a really awesome kind of, it was a great experience, great journey. And Thor happens to he just graduated, but he was a student at ASU about 2.5, 3 years ago. I was invited down to the ASU Blockchain Club for this speech. And I was like, well, why don't I give people kind of my background, my experience in crypto? If people want to get into this space, what are some really good tidbits of advice, some guidance that I could give them? And that's where I ended up meeting Thor, and that's where Zivoe ultimately started.
Wow. Wow, dude, how serendipitous to just kind of happen upon that capstone project. Kind of, I mean, it seems like were you at least interested in blockchain tech or like even knowledgeable about it before that, or did it just kind of happen upon you?
My background experience prior to that was purely, I guess I had heard about it a couple of
Yeah.
times. I knew about the Silk Road and people were using Bitcoin to buy drugs, but that was pretty much it. I didn't really understand like the software development angle of it or its like use cases or applications. Like during that time period, I read the Ethereum white paper and really got into it and understood like, wow, this is where smart contracts can go. I heard you mention that you audit a lot of like derivative products and things of this nature.
DNX, synthetics, yeah, a lot of these.
Really wanted, I worked very hard early on actually on a side project to launch like an options dex. And I had designed, this was before the DAI stablecoin even launched. And I was like, wait a second, we can use smart contracts to settle options on chain. We can do stablecoin covered calls. Well, I guess it would be cash secured puts and like ETH covered calls, stuff like that. So yeah, I've just, but it was serendipitous that I stumbled into that
Yeah.
project.
Yeah, dude, I mean, how glad are you that you ended up, just saying, hey, I don't want to do this U-Haul thing, and instead,
It really caught on too because even after I had graduated, I was so fascinated by this type of technology. I had an interview with American Express. They've got a huge office up in North Scottsdale here. And I went in for the interview and I said, look, I understand you have a blockchain team. I spent the last year working on this blockchain product and I'd like to work with you and your team on it and push that forward and specialize in that area. And the guy interviewing me said, well, sir, you see here, you have this little whiteboard and this is your 3-year plan here. You got to walk before you can run, and
yeah,
you've
yeah,
got to, go down this path of basic software engineering. And in 3 years, you can go work at any bank. And if you'd like to come and work on our blockchain team after that, you're more than welcome to. I said, that's too long. I can't wait 3 years. And so I think by the end of the 3 years was by the time I had built Maple and launched that, I would have still been in this weird track with American Express.
yeah,
Instead, I was able to contribute a great deal to the protocol architecture of this project, which is like a multi-billion-dollar AUM project now. So I think it was a good move not to go with Amex and to stick down that path. And one of the awesome things of, okay, kind of segueing into Zivoe a little bit, or I'm sure Thor's got a lot to say about his background, but I want to mention one thing is with Maple, we focused on corporate credit, which is like great. I think it was really needed at the time. And so what we relied on was building a loan book of these like large notional size loans, but just a few of them, right? Like 5 to 6 of these large notional size loans, kind of revolving every 3 to 6 months. But with Zivoe, we're actually focused on consumer credit. And it's one of the most fascinating things. It's what kind of drew me into the project initially, which was we can take a loan book, fill it with thousands of these 2K to 10K size loans, have them all effectively cross-collateralized, right? And you can actually build a very solid model with loss rates and say, okay, if we get a 15% loss rate, and our net performance is like 35%, and we get the spread, and we can deliver a 15.5% yield on chain, and like we can model that out for 100,000, 10,000, 100,000 loans, right? So it's very scalable, and like the risk adjusted return, like from that perspective, it was very alluring. And so I was like, okay, well, we've got to bring this product on chain. We need to tokenize it. And I'm not sure I would have necessarily been as fascinated or really kind of taken on the project as I did if I didn't have that experience of like the corporate credit side and seeing that like, okay, now we need to get consumer credit on chain.
Yeah, so I am interested, like, what the background and experience is with consumer credit and how you guys saw this as an opportunity. I think obviously Maple Finance was like a prerequisite for experience and seeing that opportunity, but I'm also assuming, Thor, did you have experience in this like consumer credit area before coming in and obviously building Zivoe?
Yeah, happy to touch on that a little bit. I'll maybe just kind of run down my background super briefly and can jump into the consumer credit part. I think that's part of what makes our team really interesting. Also, apologies for anyone who's watching this on video. You had to look at my nice webcam background, but it looks like we're all fixed now. So I kind of got involved in the space originally back in 2017, just as a user, kind of during that big Ethereum bull run that happened. I got involved at the time, bought just a tiny bit of ETH, more just as like, kind of, excuse my language, shits and giggles. And then, after doing that, I was like, I should figure out what it is I just kind of got involved in and, went down the rabbit hole ever since. Also, free piece of advice, never buy something without knowing what it is. Always good, but got involved kind of back in 2017 and had just been a user in the space ever since then. I did a brief stint in investment banking and then, I got involved with kind of the rest of our founding team at Zivoe, and I'll kind of touch on, their backgrounds a little bit as well. Just kind of, we're like, why consumer credit, right? So two of our other kind of founding team members both come from consumer credit backgrounds. So two of our other kind of founders previously worked at a lending company in the United States focused on unsecured consumer loans. And what they saw there was a huge unmet market demand. And one of the things that's really interesting is there was a company that started back in 2005 called Lending Club. And Lending Club was like the OG, like peer-to-peer lender. Anyone could come to Lending Club. You could fund like specific loans. Like you could literally go onto their site and choose like, I want to fund this loan. I don't want to fund this loan. And like down to like a granular like loan level for like these like $2,000 loans. And they ended up transitioning to more of like a traditional model where you go out to like a credit hedge fund and basically just go get like a really big, large line of credit. And, you just fund all your loans that way. And a couple of different reasons I ended up doing that. One is, it probably wasn't the best idea to just let people like choose which individual loans to fund. Yeah. That's just like a horrible UX experience. And two, it's just a lot easier to manage like one big line of credit than it is to like deal with all these individual people. Like, can you imagine back in like, 2005, 2006, like just from like the accounting standpoint on the back end, like you have all of these tens of thousands of users who want to fund these loans and you have to like keep their funds segregated. You need to track like which loans they're funding and manage all of that. Like that is a lot of overhead. And one of the beautiful things about kind of having an on-chain lender is all of that can just be encapsulated within a smart contract, and essentially your blockchain is acting as your ledger or your accounting software, effectively tracking all of that and kind of the movement of funds. So our team kind of came together as I was talking to kind of some of our founding team after they had exited from the previous kind of consumer lending business I was mentioning, and they grew that business to be one of the largest of its kind in the United States.
Wow.
And we kind of started working on Zivoe then, and yeah, just literally so happened to be like happenstance that I was fairly heavily involved in the like local crypto scene in Arizona, and went to an event one day, and here was John up front talking about building Maple and a credit protocol, and I was like, oh my gosh, this is like perfect. Went and talked to him after the event, and kind of the rest is history. But we have a really good kind of blend in terms of backgrounds. We have guys like John and myself and Dennis on our team who come from a little bit more of like crypto native backgrounds, although a lot of us have TradFi experience as well. And then we have kind of some of the more boomers on our team like Jay and Crystal and Walt, who have 20 plus years of experience in TradFi, just doing consumer lending. So like Walt, who is our chief risk officer, was actually like the chief risk officer at Lloyd's Bank over in Europe at one point, was a vice president of risk at JP Morgan Chase, and actually took a company called Elevate Credit Public, which was a consumer lender that operated in our space. And that company they're still around, they just went private again. But when they were public, when you can even go look at like their filings, like they had billions of dollars worth of loans outstanding at any given time. So yeah, they were quite a big company.
Yeah, well, I mean, certainly the pipeline from people aping into random coins and on Ethereum and then starting to get interested after they lost their shirt on something, it's definitely strong. I know it happened to me. I definitely aped into, the Ohm forks and all that good stuff. And that's my onboarding to DeFi. It's kind of like the cost of entry. Yeah, and I mean, thank God you did ape into, whatever it is that you ended up buying. It's kind of just serendipitous how it seems like, paths just kind of cross. I mean, to have, somebody with your background, experience, connections to people who already have a lot. I mean, it seems like you guys have already, done this in consumer credit. Intersect with John, who's literally done something kind of adjacent to it on the blockchain side. Yeah, pretty serendipitous of a founding story. But I'm interested, like, what is the blockchain aspect of this unlocking for you guys that allows this to be, let's say, I mean, ideally, like an order of magnitude better than, let's say, the previous business? Like, what is this solving? Is it unlocking a constraint that was previously there on the lender side? What's the big benefit?
So I can hit on a few things, and I think John probably has a lot there too. So as I kind of mentioned, even in the lead up to this, like the lending club example, is there is a lot of like back end stuff that goes on at these lenders that a lot of people don't necessarily see. And like that was a 2005 example, so it's a little bit more like archaic, harder to manage. But even now, right, at lenders, you use things like loan management systems, right? And these are a lot of times like third-party pieces of software you go out and like white label. And, a lot of those different pieces, add to your overhead, right? And over time, we want to bring as much of that on chain as possible to reduce your cost of actually doing business. And one of the things that's also really interesting, just from like a capital availability standpoint, is a lot of times what happens at these lenders is you actually go out and when you originate loans, you place them into an SPV or a special purpose vehicle. And that's just a company set up for like a very specific purpose. In this case, actually custodying loans. And you go out and securitize that and you're able to then go get liquidity. Now, those kind of deals are typically only done OTC and they're, kind of only available at certain times. Whereas if you're able to bring this on chain, you're able to give liquidity to a token, for instance, and John can talk more to that. You're able to do that at any time. One of the other things I think that's really interesting too, in Lending Club tried to do this back in the day a little bit, is I think there is a benefit in terms that you're actually able, I think over time, to lower your cost of capital by allowing anyone in the world effectively who qualifies to come and actually fund some of these loans. So I think there's a whole bunch of stuff I could touch on with that. And, I'll let John kind of hop in as well.
Yeah, and it also seems like you've opened up your market of lenders to, I mean, unless you're really doing a lot of work on the UX side, it's now a new market of lenders. Like I can imagine from, I think it was Lending Club, the target lender is probably a little bit different than the target lender for Zivoe, because I can imagine they've got to have assets on chain to be able to deposit into the ZVLT vault. So are you guys starting out with the target lender as somebody who's already DeFi native and then trying to expand from there? Or are you guys already going straight to, lenders who are, Web 2, they have no idea what Web 3 is?
So we actually are catering to both versions of that type of client. So there's DeFi native clients and there's TradFi native clients. We're actually right in the middle of a partnership and integration with a custodian where effectively you can have a Web2 experience. So if you want exposure to ZVLT, all you have to do is just wire capital, fiat from a bank account onto this platform. And we're setting up this integration to where you can simply, just click a button or request for them to execute a certain transaction, and it'll, on the back end, they'll handle fiat to stable coins to ZVLT, right?
I see.
So, and the nice thing about that is if you're more of a traditional investor, you don't want to work with wallets.
Yeah.
If you don't want to work with, gas and all these things, they're going to handle all of that for you. It's also insured. So if you don't have to worry about the self-custody. If you would like somehow, well, they're not going to let anything happen in their system, but you don't have to deal with like, oh, I sent my tokens here. It should have been over here. So that's how we're working with the TradFi traditional investors. And then the DeFi native side, I mean, we have our Web3 applications, so people can just come to the platform, deposit stablecoins. That's how we're going to market there. Your previous question about how are we unlocking value for this particular asset class using blockchain is huge. Like there's a lot of meat on the bone there, right? Directly clear right off the bat. And it's so nuanced. It's really like an onion. Like you start to peel back the layers, you can see like why this asset class is particularly ripe for tokenization. And so I'm going to try and start biting away some pieces of that, right? To begin with, actually, there's been a huge trend in user bases across all of these various chains, Ethereum, EVM compatible chains, side chains, and these particular ecosystems where their user bases have a lot of capital on them, but they reside in certain countries in which they're just not able to really generate good yield off of its sector, right? So for example, like in Japan, Korea, Hong Kong, like these types of markets, it's actually very hard for them to generate yield just like a cash in a bank account. And they like to use crypto. So they come to crypto and they see, okay, I can generate like 4% on stable coins. And even that is starting to trend downwards now. And so we're kind of shifting towards this very low yielding crypto environment.
Yeah.
And even in traditional finance, low yielding kind of bank accounts environment, right? I mean, we've certainly been trending upwards over the last few years, but now we're, I think, trending downwards on a macroeconomic scale. And what we've been working with on a lot of these different chains is saying, hey, what is it that you're looking for? What are your long-term roadmap for your users? And they're like, well, we have a good application system, so like user apps, mini apps, stuff like this. We've got a ton of users. We're licensed in all these countries. We can onboard these particular demographics. We lack DeFi native crypto yields or RWA tokens that generate a yield based on off-chain assets. We are, I'm actually incredibly bullish on where our project is in the overall trend of the space, because what I see happening is you've got these large user bases that are looking for yield on assets in their wallets.
Yeah.
And so, right now what we're doing is we're partnering with these different chains to integrate onto the chain, whether that involves doing a standalone vault or deployment on their chain, or whether they can use some kind of cross-bridge, like bridging liquidation. I don't know exactly how you would call it, but they have these like liquid systems where if you have a token on one chain, they can replicate it on the other, and they have like stable coins. So if someone has a stable coin on this chain, they'll like, okay, buy it, and then it'll work with stable coins on other chains, and really easy for us to integrate into these types of systems. So I think we're going to be seeing a large trend towards crypto users just looking for yield out of their assets, right? And that market really doesn't exist. It's very early on, and I think there's ways that all of these projects that are generating yield can differentiate themselves. Yeah. But I almost feel like if you were to walk into like a store and you were to say you like beer and you're walking into a store and you're looking for some nice craft IPAs and you're just walking down the aisle, it's going to be like 3 or 4 selections, right? Like there's very little variety, and it's all very watered down, 3.5%, Michelob Ultra, stuff like this, right?
Bud Light.
And I kind of liken ourselves to like a very strong craft IPA, very well made and delicious. I just came up with that metaphor on the spot, but I think it's actually
Make it
very
work.
apt. Yeah, and to kind of tie it into like the financial metrics side of things, I really believe our asset class is one of these like most hedge fund, even on the institutional side, like I'm talking more on like retail side and having options, but even institutional clients, like they're looking for higher yield. Generally, with higher yield, you have to go farther out on the risk curve. But I really believe that we're building a product that takes you higher out on the yield curve, but lower down on the risk. So it's just a higher risk adjusted return with private credit. And that's like one of the layers. You peel back one of the layers of DeFi.
Like an ogre. Yeah, dude. Well, I mean, first of all, there's a lot to address there, and I think we'll get to the scalability of the opportunity because I think that's another really important aspect here. But I mean, to touch on the point of like you're offering a new like yield that is totally orthogonal to what is already existing in the existing DeFi ecosystem, and I think that just enriches the rest of the ecosystem, and I'm excited to have more of these products coming in and offering these off-chain Web2, real financial world like opportunities to the capital that's already on chain. Because I mean, the beauty of DeFi is that once you do bring that on chain, it's infinitely composable and people can start using your ZVLT tokens and start using them in other DeFi applications. And that just exposes the value of the yield that you're bringing on chain to every other application, which can now build on top of it and provide, maybe even more value. Maybe you can lend against the ZVLT tokens as collateral, whatever that might look like. But yeah, and I think that's the beauty of DeFi. And once we get more applications like this, more opportunities like this of, folks like yourselves who understand the TradFi aspect of this and have all the know-how of like, we've got to connect this to this, and then this is how we're going to market this. This is how we're going to, give out the loans and stuff like this to bring that on chain. And now everybody can benefit from that all at once. So I think that's where we really get the flywheel started. And then DeFi will just become infinitely more valuable and suck in more opportunities. And eventually it will have so much capital just pooled on the networks that it's like, well, that's the first place you want to go to get capital for something like this. Because I mean, you guys are in an interesting spot where you've got the on-chain sort of self-custody. You hold your own ZVLT tokens. You do whatever you want with those. And then you've also got the custody solution where it's, you just you wire however much, and then the custodian holds it for you. You don't even really understand or know, what these tokens are. So yeah, it'll be interesting. I'm also interested, like, what's the split that you guys are seeing right now between the two? Is it mostly one or mostly the other, or is it 50-50 between the two?
Between our custodian. Well, we're currently integrating with them right now. So we are developing the technical rails basically to onboard users, and we're doing a prototype. So let's say within the next 4 to 6 weeks, that solution will be in place. Maybe 6 to 8. I don't know. I'm always saying it's going to get done sooner rather than it does from an implementation perspective. So 100% DeFi native right now, right? Gnosis Safe's best solution out there on the market for these kinds of things, multiple signers on them, pretty secure, hardware wallets, things of this nature. Oh, and you touched on a very interesting number of things there, and I think that's the second layer we can peel back, which is like
Let's get to it. Let's do the second layer.
DeFi composability, right? Like actually leveraging, that's a bit of a double entendre there, but leveraging on-chain DeFi mechanisms for the benefit of yield, risk, diversification, whatever, right? There's a number of vaults. If we think of kind of this revolution of AI agents taking over and managing treasuries and allocating certain portions of these vaults or DAOs to different protocols within the space, I think this is a huge market for us to tap into because in general, I mean, it depends on the strategy of how they're trying to diversify their portfolio. But if there's a component that's looking for stable, like high yield tokens, so we're currently generating 15.5% APY on chain, then we can be a very strong component of portfolios that are looking to allocate towards that, right? They want to go higher on the risk curve. They don't want to be in like 4% stables, but they'd rather be in like 15.5% like private credit.
Mm-hmm.
And then there's always going to be these agents that are like, full pedal to the metal. Let's take a quarter of our portfolio and throw it at these like 5 random meme coins, and they're going to either 10x or go to zero, right? So I think we can fit into this space very well, and by just showing, over time a consistent, stable yield, and I do believe portfolios will latch onto that, whether it's even if it's human driven or AI driven. That's one thing. We also talked about leverage, or there's a very common loop leverage system in the space, using Pendle to split your token into principal token and yield token and creating a borrower market. Against that, we would do the yield token on like Morpho or Euler. And you can kind of create this system where you're borrowing against the initial yield token, selling it off, creating more. You get into that like 5, 10. Some trading firms will do this like 19 times on ETH derivatives, ETH staking derivatives, right? And they somehow take what would be a normal 3.2% yield and jack that up to like 15 or 18%. Now, if we're starting out at a 15.5% base yield and you start looping that just a couple of times, that gets very interesting very quickly. And so we are currently working with a number of curators on different platforms and going through DD to pretty much onboard our ZVLT token into this type of system. It's our belief, it's come to be our belief after having worked with a number of firms that are trading firms, hedge funds that are essentially doing these types of loop leveraging system, that like a North Star for RWA protocols is to basically get into this type of loop leveraging system so that you can just extend the yield that you have, because if the underlying asset class performs in the anticipated way, obviously you're taking on higher risk when you leverage, but you're still extending, basically you're maintaining risk adjusted returns. So it's something we're actively working towards right now.
Yeah, and I mean, you pointed out that one of your strengths here is just that you have a yield source, which is just completely uncorrelated with the existing DeFi market. And in that sense, you can probably fit into a number of sophisticated portfolios now on chain that want to include this yield source that's not correlated to whatever ETH staking is yielding, and not correlated to whatever, Aave has for whatever ETH market or something like this. But also, yeah, when we start to talk about leverage, then obviously the risk starts to become increasingly important in how do we observe that and how can we actually quantify it in models. And I think this is another aspect that we could probably dive in very deep, is first of all, the scalability of this opportunity in terms of, well, first of all, it's not so discrete. Like you said, with Maple, you have less agreements, but you have much bigger agreements. And I guess you could say your exposure to, let's say, like the standard deviation is more concentrated. But then if you scale this amongst like 1,000, 2,000, 5,000, 10,000 individual loans, then you flatten the curve and it's all very predictable. So let's go all the way to the fundamental atomic case. What is underlying? What are some of these loans? What do they look like? Are they like auto loans? Like, what is this consumer credit at the base level? What is actually happening on the ground?
Yeah, happy to kind of jump into, the actual loans that Zivoe is backing. So the loans that we're focused on are loans between $2,000 and $10,000 in the United States, and these are actually unsecured consumer loans. So, you kind of touched on something there, which is like when you flatten them out and you have like 10,000 of these, you can kind of predict how they can perform. So this is kind of a space that's been around for almost 50 years now, and there's a ton of credit data going back on it, that's publicly available, and tons more that's not. Companies in their 10Ks and stuff, regularly report kind of this stuff. You don't necessarily know how one loan is going to perform, right? It might be a coin toss, and it's not, necessarily worth funding one loan for, let's say a 15.5% return. However, when you have 10,000 of these loans, or even a couple hundred, it begins to become a portfolio that you can predict the performance of using analytics. And that is where it gets really, really interesting. And that's also where I think even the experience of our team comes into play significantly, because you really need to understand how to underwrite those portfolios and how they're going to perform. And that is something that I think we bring to the table in the RWA space that's really unique to what we're doing. So I guess to kind of circle back to it, yeah, these are loans between $2,000 and $10,000 in the US that are unsecured. And effectively, we put them through a full underwriting flow before they're originated. So just to maybe like shed a little bit of light on like what that would look like someone would come and apply for one of these loans, and typically like someone is pre-approved, so we already kind of have an idea of like who you are before you're coming to apply for one of these loans. And you can get data from like credit bureaus and stuff that allows you to kind of do that. And when someone comes and applies for one of these loans, they input their information, and then you kind of have like a soft decision out of the gate, like, hey, based off what someone's entered, we'd probably approve them or not approve them. And then if you think you would approve them, you kind of will take them to like a next step and put them through like a true underwriting flow. Like you'll do credit bureau polls, and then you'll put them effectively through a decisioning engine, and literally will pull like thousands of attributes. You only end up having some that are like actually significant that you're actually like underwriting on. But it's a very intensive process when you're actually looking at this. And one of the really interesting things too, with these models is as you continually underwrite more and more people, is the models get better, right? Because you begin to kind of look for attributes that are common between people who are paying on time and paying successfully versus
Mm, yeah.
focused on specifically, that opportunity is tens of billions of dollars. So just to give an example, like Elevate Credit, the company that our chief risk officer took public once upon a time back, and I want to say 2014 or 2016 is when they went public. At the time they went public, they had just under $1 billion in loans, and that's like a mid-sized company in this space. So like a lot of these companies have multi-billion-dollar loan books. And the thing that's really interesting too about consumer loans is at the end of the day, all a consumer loan is, right, is a contract. There's not like a physical asset associated with it. And I actually think that lends itself to scalability, because like if you're tokenizing like a true physical asset, like something like gold, you have to custodian that, you have to manage that. And there's like physical assets that you have to like continue to stack up. And that adds another element to like how you're able to scale it. And like we talk about real world assets now, and right now we take capital off chain and we're using that to originate consumer loans. But like going back to it, the beauty of a consumer loan is it's just a contract. And so like we're going to get to a point where you should be able to essentially do all of this flow like almost entirely on chain, and eliminate even more of kind of like the services in the middle that you're relying on, like I kind of talked about before, like a loan management system or some of these different kind of payment providers even, or servicing providers. And so that's where I get like really, really excited about like where I could see us, let's say 5 years from now.
Yeah, and I mean, obviously, I think you guys also work with some partners on like the underwriting side. So it's not even just you guys who are doing all the underwriting. You have like third-party agencies that are, well, and obviously the credit bureaus and stuff like this. People who do this, and they've done this for decades at this point, right?
Yeah, exactly. We work with a company called Zenclusive that actually is kind of doing a lot of the end underwriting. And to your point, that team has been doing this. I mean, combined within that team, there's probably hundreds of years of experience with literally like just credit underwriting. And so that is something that I think is very unique to us in the asset class that we're focused on. Because I think there's like a lot of opportunities in RWA right now. And I think a lot of the technology is really good. But I think, there's a few teams that do it well, like meshing the like technological expertise like we have, in John internally, but also like the financial expertise to manage risk effectively as well.
Yeah, and it's actually pretty exciting with the advent of AI. And like you mentioned, like as you get more data, then you can optimize and improve even the risk adjusted returns based on what kind of loans and the parameters that you optimize for. So I mean, that's a pretty bullish sort of input for going and actually scaling this thing. It actually gets better as you scale it because you have more data instead of the headwinds kind of scaling against you, which unfortunately happens in a lot of these yield opportunities, especially the ones that are on chain. So I think that's something that will allow this to, I mean, who knows? I mean, what is the bottleneck? Has the bottleneck in these businesses typically been on the lending side, or has it been on the lender side?
So it's a little bit of both on that. I think in terms of like the borrower side, like people actually taking loans, is you can scale these portfolios to be billions and billions of dollars. Like that is very normal. Your constraint on that side, right? If you're managing risk correctly, is you can't just go out and lend a whole bunch of money in a really short period of time. Like it takes time to get to scale, but the scale is, for all intents and purposes, pretty unlimited. You just can't go out and go lend, a couple $1 billion in a year, but you can lend, let's say a few $100 million in a year once you're like really up and running and at scale and kind of have your model styled incorrectly.
Yeah, I can imagine a lot of it is getting the infrastructure set up and the relationship set up to have that stream of volume which you can fill from the lender side. And then obviously the flip side of that is just getting the volume to be able to lend out in the first place, which also takes a lot of infrastructure relationships and whatnot. But on terms of that side, what do you think is the catalyst? I mean, I think it's a pretty easy sell to sell like 15, 17% APY. Do you think that is enough? Or are you guys trying to build even more on top of that?
So we're definitely trying to build more on top of that. And I'm going to kind of throw this to John to talk about because we, kind of came out of the gate with like an MVP DApp that we had built internally. But, we just went out and kind of did a full, UI, UX, like redo from scratch along with the new ZVLT token. And I think that's really going to lend itself as well to kind of driving additional TVL along with some additional things we're doing, like kind of Pendle and looking at some of those things. So I'll let John kind of hop in and talk about that a little bit.
Yeah.
Yeah, Owen, this kind of goes back to this trend I was talking about with different chains with different user bases that are effectively looking for more yield. So in general, I would say the bottleneck or the challenge that we face as a business is ultimately sourcing the demand side for this yield. And I say that because we have a very strong supply side system in place to, once we have the capital on chain, to then deploy it. And it's been our primary focus over the last, let's say, 3 to 6 months. Well, perhaps it's primary right now. I'll say secondary was we were launching this new Vault token, but we're going to go live with a new DApp. We've been working with a design agency over the last couple of months as well. So that's going to complement the Vault token. And we're just doing basically just deposits, withdraw, and then we'll be like releasing additional pages. So you get a nice portfolio dashboard, nice governance dashboard for all of the tokens within our ecosystem. But right now, our primary focus is really expanding our reach on chain to source capital.
Yeah.
And so, again, we're partnering with a number of different chains and exploring what our best options are from, we have to evaluate everything like feasibility of integration, closest path to revenue. That's certainly something any business needs to consider is like which, maybe this chain has a very large user base, but it's going to take us 6 months to get there. So, okay, let's take a look at these ones we can get out in the next 1 to 2 months, start building some momentum. But I think we're very well positioned. We understand it's a challenge, and that's pretty much what we're currently focused on. It would be phenomenal to have ZVLT on a number of different chains. Ideally, the best chains that we go to are the ones that we can kind of create a wrapper. The one thing I'll say from a technical perspective is bridging is not ideal. Deploying a replication of a system on another chain and then bridging capital from one chain to the other. There are some systems and solutions which kind of use bridging, but in a sense, it's not the bridge like Stargate Finance. It's not like we're just kind of sending stablecoins off into the ether from one of our contracts to another, having some kind of wrapper for a token, or just maybe having standalone lightweight implementations. These are the kinds of things we're looking at and considering.
Yeah, and I think also a lot of where you guys determine that you're going to launch on first is dependent on the integrations that you want to have. But what kind of integrations do you guys want to have in the next couple of quarters? If you can share, if we're not going to spoil your marketing.
To be quite honest, I'd rather not share right now.
Fair enough.
When we're able to, we will. Let's just say that much. But no, they're very huge and exciting. All I'm going to say is they're very huge and exciting partnerships. It's more just like there's no really reason for us to disclose until it's in the bag and we're like, deployed. It's kind of like raising capital from investors, right? Like you can paper the deal and it's like,
yeah.
But until the money's in the bank, I'm not going to say anything.
Yeah, that's true, of course. And you don't know, what kind of roadblocks you're going to run into. But obviously it sounds like we're going to have some form of leverage. Who's to say who's going to end up ultimately providing that, but some form of leverage for ZVLT. I'm also interested actually on the technical side because obviously this isn't the most liquid thing, but then I think you mentioned you can have this securitized and have some counterparty who's offering liquidity against your loan book. What does that look like when you bring it into an on-chain context? Is it like a two-step withdrawal from the vault? Like, how does that work?
So actually, we have two on-chain and let's say a third off-chain solution for how we're handling liquidity and redemptions from within the system. So to begin with, and this is probably the most attractive option, is atomic liquidity, which is a direct one-to-one or direct redemption for NAV, net asset value, out of the protocol. So what we have in place, although we haven't built, we just need to launch it on chain and actually deploy it. This is all part of this, like over the next couple of weeks, we're going to be launching this. It's an instant redemptions locker. So if you have ZVLT, you can effectively burn the ZVLT, and we will have stablecoins within the protocol that you will receive in a one-to-one basis based off the NAV, because our vault tokens will have this index price that's just linearly increasing as it accrues value. So maybe it starts at a 1, then it's 1.01, 1.02 per token. So based off that index price, however many shares of our vault token you burn, you would instantly receive liquidity out. This is, as we're noticing, very valuable to curators and parties that do lending for like loop leveraging, stuff like this, right? In conjunction with that, we have a partnership with Frax where we will be deploying a 500K liquidity pool on Curve Finance. And what we're doing there is actually, it's actually really cool. This is one of the things that's like, yeah, blockchain has some really awesome things, which is there's a pool type called ERC4626, which that's the standard for the vault token. When you launch a Curve Finance pool, you can specify that it is an ERC26 token. And what it will do is look at the amount of underlying asset that's in that vault token and say, okay, we're going to track the exchange rate on the DEX in accordance with that index price, right? So instead of someone having to, like, say, constantly buy up and kind of maintain some sort of peg to the NAV on that market, it's just algorithmically adjusting the exchange rate based off of what the effective market rate is, the effective index price. And so it's nice because we have an auto compounding token. Auto compounding in the sense that every time you compound it is a function on chain, it updates that index price, right? And so what's nice is we can kind of just see, every 6 to 12 hours, hey, our token is appreciating in value, and the exchange rate on that market will constantly be adjusting. Maybe there's some very short-term arbitrage, opportunities in place based off of compounding it and stuff of this nature, which is fantastic. The market will take care of that, or someone can come along and build an algorithmic solution to maintain that. But that's just MEV for you. But it's actually really cool building systems that create MEV opportunities on chain as well. So
yeah, the curve pool should minimize that as well because it's automatically adjusting the price rather than relying on somebody coming in and arbitraging it and, essentially taking value from the LP there in that case.
Well, if it hasn't been compounded for a while, you could theoretically buy the token, compound it, and then sell the token off at a higher rate. Now, I don't know. I mean, I think if you'd have to do that at a pretty large scale and deal with fees and whatnot. But honestly, it's cool because that forces someone to call the compound function while also deriving value for it. So you're creating MEV that forces people to compound your token.
I would say to an extent. I mean, it depends on because you could maybe flash loan a ton of money and then just take the compound value by inflating away the token supply. But if the fees are large enough, I guess that's the lever is if the fees are large enough, then it becomes unprofitable.
Yeah, and there's always atomic liquidity available at NAV as well. So that would not take away from that particular part of our system. So those are the two on-chain systems that we have as far as liquidity for our token. For larger, this third off-chain is really for our, say, larger institutional clients, people that want to come in with a $5 or $10 million position. What happens is this would need to be done on more of a face-to-face basis. But basically, if they say, hey, we put 10 in and we'd like to redeem this, what we would do on our end is look at a particular tranche of loans that we have out and say, okay, what we can do is basically take the interest payments from this, and within like an 8 to 10 month period, again, it really depends on size and how the portfolio has scaled at a particular point. So we're going to take, principal and interest from this and like set it aside, and you can basically wind down a portion of the portfolio if someone wants a redemption. And I think that's quite feasible within a 1 year period for certain positions. So this is, again, it becomes much easier to do that at scale, right? But these are things that we can facilitate for like larger size position.
Yeah, and I think it also helps kind of like on the lending side, having a lot of these smaller loans, and also on the lender side, having, not like just 2 or 3 whale lenders who all of a sudden when they say, oh, we want to pull out, now your whole loan book is kind of messed up. It helps to have this DeFi side where it's like you have a lot of the smaller mid-tier lenders, and in that sense you can sort of model out, and just like you can on the lending side, you expect some rate of redemptions to happen. You can have liquidity for that. And obviously, yeah, there's a lot of interesting risk parameterization that needs to happen to understand how much leverage can some of those venues offer on something like this, and based on what kind of liquidity. But I think the beautiful part is that as all of this scales, you can employ more leverage, and you can even probably get a even better risk adjusted rate. So it scales very nicely, which is great to see.
Peeling back the layer a little bit more, one of this like really interesting on-chain mechanisms that we can do is let's call it wiping debt from the system. Oh, say we have a secondary market up and it's trading at 98.5% of par value. So our index price is like $1.15. It's trading at $1.13. Like, okay, what can we do here to take advantage of this particular discrepancy? And how can the protocol at large actually generate value, derive value from these kinds of discrepancies in markets, right? So let's say we have unallocated capital in our DAO. Theoretically, we could build a system that would buy up these vault tokens at a discount and burn them. And so what this is doing is basically it brings capital out of the system, right? But you actually are building equity for the entire system at large, because if someone puts in like $1 and then we buy back that dollar for 98 cents, we've now just generated 2 cents of free working capital. If we can do that, like let's say we scale up to like 100 million, 200 million TVL, and we're able to do this like debt wiping system over like, I don't know, 10, 15, 20 million in volume per year. Like that's pretty low for that kind of like TVL, right? Well, let's just say 20 million, 2%, that would be 400K, right? So now we've just kind of generated 400K in value out of nowhere. And on top of that, we have in effect created a more stable market where, as a result of us buying up our token, it stays closer to par value. So if people want to just cash out like 5, 10K, they want to sell off a little bit on the market, like we can facilitate that, and we can maintain it at peg too. So like every time it comes down a little bit, we just have something that automates like buying that up. And I think that's going to generate a considerable amount of value.
Yeah. Yeah, because when you do get into that state, I assume it would be when you don't have atomic liquidity to withdraw on chain, burn those vault tokens, but burn them in a way that redistributes the value to the rest of the vault tokens, and not just like locking that portion of the supply. Yeah, I think I mean that's another way to, well, you keep the market in line, and then now all of those people can atomically just swap out of it, keeps it very liquid, and it just redistributes that inefficiency back to the holders of the vault. I'm interested in, so obviously there's a lot of the infrastructure that you guys have to lay out, and this is kind of an interesting DeFi project because normally DeFi projects don't have so many different layers of infrastructure and providers that they need to interact with, and you touch up against all this different surface area in Web 2 and traditional finance. What kind of regulatory, on the regulatory side, I can imagine you guys probably have some legal gig brains in your corner who have done this kind of thing before on the consumer credit side, but what does that look like when you marry it with DeFi? Is there any particular consideration there? What has that been like?
So I'll touch on this a little bit, but I'm not going to go too deep. So just one of our founders, Crystal, is a consumer regulatory compliance attorney. So this is her
Well, that helps.
wheelhouse, and she's been doing this a long time. So I don't want to misspeak, but at a high level, we're following all applicable rules and regulations in terms of, actually conducting like KYT and AML checks and all that kind of fun stuff. And so the way you can somewhat think about it is it's no different than any other fund kind of lending into the United States. You need to meet all applicable rules and regulations.
Yeah.
And, there's stuff you have to make sure you're doing there, which, as I mentioned before, we're kind of conducting all those required checks. So yeah, no, that's something that's definitely super important. And we have, kind of covered our bases in spades there. And, I would probably leave it at that just because it's not my, wheelhouse as much. Yeah. But no, that's something that like internally we have a ton of experience with.
Yeah.
Just given her background, and we also have outside counsel as well that's kind of very reputable in the space. And so no, that's something that like we take very seriously. Like obviously if you're touching real world assets, like you have to follow all applicable real world laws. Like that's kind of part of the deal with RWAs. And so that's something, yeah, if you don't, one of the easiest ways to go out of business is to not follow, all applicable rules and regulations. And, we would like to be in business for a long time.
Yeah, that helps. And so, I mean, technically speaking, did you guys implement any like checks, like KYC checks, even just depositing into the vault, stuff like this? I know there's products like Predicate that have been working on this, a few others, but yeah, did you have to implement some of those checks on chain with the actual vault?
Yeah, we have some of that stuff built into our UI. So yeah, there are our kind of checks and stuff in place. Like we work with Chainalysis on like the KYT front in terms of like screening wallet addresses and stuff. So yeah, we do perform those types of checks.
I see. Yeah, and I guess, I mean, yeah, it's interesting to see. I mean, it depends on who I talk to, when it's like the front end versus the contracts, and it's like what entity owns the contracts and all this stuff. But that stuff goes all way over my head. In terms of what you guys are working on right now, it sounds like the vault, getting ZVLT out, and then UI UX overhaul. What else is on the timeline if there's anything coming up?
So I think something that might be worth touching on that's really interesting for like the demand side, and I think is like something that is really interesting just like for RWAs as a whole right now is, in the second half of this year, one of the things we want to release after kind of getting our new DApp out and launching ZVLT is like a loan transparency dashboard where you'll be able to kind of go and see all the actual like off-chain loans and the performance of those loans. And John can talk probably a little bit more about that from like the technical side of how all that would actually work. But I think that's something that's super, super important, right? Because like with all RWAs right now, right, like we have, a very solid structure in terms of like how our assets are flowing, but it's still kind of like, hey, you to some extent have to take like our word for it. And like we are a team that's done this for a long time. We're all docs, we're all like US citizens, and we've all kind of been in the space for a while, and a lot of our team has been in business, as I mentioned, for like 20 plus years. But with any RWA protocol, like there's only a few right now, I think, that do like a really good job of actually like providing attestations of like assets that they're involved in, and most of those are like treasury related projects, and so that's a lot like of a simpler like thing to actually go and implement. So that is something that like in the second half of this year we're going to roll out. I'm still working through some of the stuff in terms of like what we can and cannot show, because there's like PII that you're not able to show, for instance. So kind of working through some of those things now, but that'll be coming in the second half of this year. So that's one of the big things we kind of have coming down the pipeline that I think is going to be super cool, and also like really good for the demand side as well, because I think that's just going to be another like level of increased confidence that, like, hey, this is where like all of this is going.
Yeah, and it speaks more to the ethos of people who are already in the DeFi landscape and looking to invest in opportunities that are transparent. I mean, you might not be able to see everything exactly on chain and all of that, but if you see the actual loan book, all of a sudden it becomes a lot more real. It's not just like 15%, 16%, whatever, you just see number and then you're like, oh, okay, I guess that works. I guess it doesn't. And I think that's really important when it comes to DeFi, because we do have all these different opportunities where it's like 30%, you're going to get 30% leveraged concentrated liquidity farming or whatever. And a lot of these, if you look into it, it's like, well, I mean, there's so much like impermanent loss going on under hood or, whatever. It's hard to even assess, right? So it's hard to even compare these APY numbers. But when you have like the actual addition, like atomic unit value of what is producing this income, it becomes very variable. And I think that will speak to especially the DeFi market.
We're a very transparent team. We're also an agile team, so we listen to market feedback, and yeah, essentially, investors want confidence in the underlying asset that they are investing in. So it's like, okay, what's the best way for us to provide that? Because we are trailblazers in a sense that no one's really doing this right now. So it's not as if there's like a tried and true path to providing consumer confidence and transparency. So we're just coming out with our own ideas and delivering in the best way that we see fit for the markets. And I think over time we'll be able to adapt as hopefully people come to us. They say they want to see something, and we'll evaluate it. And if it's a good idea, we can proceed with it. We're not like we're not a closed doors kind of company. So yeah, we listen to market feedback.
Yeah, excellent. I mean, of course, the more time that you are in the market and you show like, hey, over and over again, this is actual real yield, I think that will just have a Lindy effect. And of course, it's beautiful that it can just be on chain and other protocols can start to integrate it as well. And like, it gets kind of interesting when you have those people kind of doing your go to market on your behalf. So, I mean, I'm excited to see what the near future holds for you guys. But what is the long term? Where do you see Zivoe in, let's say, 5-10 years? I mean, that's really not even that long of a time in this kind of an opportunity, but let's say in a decade, like what is the ultimate version of Zivoe?
A decade. I'm gonna give my opinion, and I'm curious to hear Thor's opinion as well. 10 years is a long time. Let's go with 10.
Crypto, but let's go big.
Yeah. Well, I think we have. Okay, so let's kind of look at where we're at right now and where we could be in the future. So we essentially have the entire system proven out. In my opinion, right, from like the DeFi, from the TradFi side, we have the ability to basically scale with our current infrastructure to like, I don't really think there's a cap. Let's say it's just a couple billion, right? This would stem initially from the lending business, our partners inclusive, but we've been working with banks lately and to develop partnerships where if they have existing loan portfolios and we suddenly have a large inflow of capital that we cannot deploy through Zinclusive, we can buy loans that are within the exact same markets that we're looking at. We can say, okay, this is the private credit, like this is the model that we want. These are the appropriate risk metrics. This is the kind of yield target that we have. We can just buy loans off an existing book from a bank, right? And then bring that into the exact same structure we have, which is an SPV. The DAO, the protocol has the rights to all the interest payments from that. And it's basically just kind of expanding the current, like on the legal side, the current infrastructure to house these loans and deliver that yield on chain. And that's just within like private credits and US banks. Yeah. There's also, and there's two other things we can do. So there's actually a very large demand for the types of lending that we're doing, whether it's refinancing high interest loans or installment loans for like just consumers in general. Markets like Crystal would know this so well. The other markets that we're trying to go into, I'm probably going to mess up the countries, but LATAM, East Asia, and a number of these markets, like there's really good opportunities in other countries for us to expand the same type of lending we're doing in the US, but to other countries. And that just requires effectively expanding. It's more of like a exercise in, I guess, the legal side of things, setting up entities, being compliant within these countries to do lending, sourcing the data from within these countries. It might be harder to source the appropriate data. In the US, you have very good data, very good banking infrastructure to source that. If we can achieve that, and if banks evolve in other countries to allow us to do the same type of lending with the same kind of metrics and attributes that we do in the US, and I think that will happen in the next 5 to 10 years, we're going to expand globally into different geographics. There's also like, if you look at Zivoe as more an ETF for on-chain private credit, we can expand into other aspects within private credit. So there's something like called the merchant cash advance, the MCA industry. which is an alternative form of private credit, more to like, let's say, businesses, smaller mid-sized companies. But it kind of falls within, it's not like large corporate size. Maybe it's like somewhere between like, I don't know, 5 and 50K or something like that. Hopefully, I'm not talking out of my ass on those numbers, but we happen to know some people within that particular industry that have like, I think over $500 million out on the street already, and they're
Yeah.
looking to sell off a portion of that portfolio, and they're Web3 friendly, and they understand what we're doing, and they were like, yeah, let's tokenize this, let's sell it off and get some liquidity out of the portfolio. They want to do like
Yeah.
a little bit, not a whole lot. So again, I think Zivoe presents a very strong portal to private credit on chain. The supply side is there, and that's why our primary focus is on the demand side.
Yeah.
And if we can solve that, we have both sides of the equation and we can scale up. So I see us evolving into a ETF of on-chain credit, private credit of sorts.
Beautiful, man. And Thor, I guess anything you want to add to that? Any other details for the long-term vision of Zivoe?
No, I think John nailed that pretty well. I mean, if you even look at like some of these traditional finance companies, right? Like, and I'm using them over and over again just because it's an example I know well. But like a company like Elevate Credit or Nova International, which started out with like unsecured consumer loans, and then they branched out into like auto loans and kind of tangential products, right? Like that's a pretty normal life cycle because a lot of the like customer base you're touching, are fairly sticky and are looking for some of these other products too. The one thing I would add to what John kind of said too, that I think, is really interesting, for instance, like expanding outside of the US to some of these other markets like Brazil and stuff, for instance, is when you get into some of these markets, it becomes possible to do like a direct to consumer loan origination from almost on chain and a manner that to me has always been like the holy grail. That gets me like super jazzed because like you can just do a whole loan flow like from directly on chain from the protocol to an end consumer in some of these markets. That's not necessarily possible in the United States. And so like that's another aspect that of like long term where we're going to go that gets me really, really excited. But I think John kind of nailed it on the head. So we're really happy with where we're at right now. And I think, we've got this new kind of dApp and UI coming out along with the new token. And, now, as John said, the focus is really on kind of growing the demand. We've been out to market for a little bit, just kind of almost in like a pilot, just proving out that everything works, getting kind of lending up to scale. And now it's time to kind of put the pedal to the metal, so to speak.
Yeah. Yeah. And I mean, like John said, you guys have such an opportunity on the supply side. And it's also such a unique, like diversified opportunity relative to everything else that's available in DeFi today that, I mean, it almost seems inevitable that you guys just keep shipping and just keep consistently showing the revenues and, having good risk adjusted returns. Like to me, it's almost inevitable. And then, I mean, you go and you add an appropriate level of leverage on top of that. I think, it's a match made in heaven. And really at that point, it's only a matter of time. And I think this in particular, you guys benefit from having the exact right team to do this because this is not a product which you want to invest into with a team that hasn't already learned all the lessons. And there are probably a handful of mistakes that you could make in this kind of a product, but you want to have the people who have already made those mistakes with somebody else's money like 10 years before. So, and it sounds like that's exactly what you guys have.
Yeah, 100%. I mean, it's kind of a beautiful marriage of, the kind of DeFi side of this and the technical expertise that John and our development team brings to the table. And, the team that comes from TradFi and kind of has been, lending for 20 plus years has, to your point, they made the mistakes 10 years ago and kind of know the ins and outs of how to manage these portfolios in a way that is a huge bonus. I think I want to say this is a quote. I could be completely wrong, but I'm pretty sure it's a quote. But, a lot of, I think, fintech companies, a lot of times they have the technology component down really well, but they kind of overlook the finance component of it sometimes. And like at the end of the day, that is what is, making money. And so you need to have both pieces married together really well.
Yep, absolutely, man. Well, I mean, first of all, you guys are in a really exciting spot right now. I think, if we had done this maybe in a year from now, you'd probably already be scaling to those, hundreds of millions and beyond. So yeah, dude, I'm just excited for you guys and what's to come. Is there anything in particular we should push folks to? I mean, of course, we've got the ZVLT vaults are going to be coming out probably around the same time when we release this episode. The UX overhaul. Anything else that we should shout folks off to?
I think those are the big things. Definitely check us out at, Zivoe.com. That's Zivoe.com. You'll be able to kind of get to all of our different, socials from there, our documentation, which we have, very detailed documentation kind of going over the whole system, how everything works. And yeah, definitely check out our new product launches coming up at the end of the month.
Excellent. All right. Well, of course, we'll have Zivoe linked down below. Of course, we'll also share Thor and John's profiles as well in case folks want to, have any questions or anything like that. If they're looking to check out the investment opportunities in the Vault and ZVLT, that's going to be dropping very soon. You guys can check it out on the website down below. But yeah, I want to say, first of all, John, Thor, thank you guys so much for taking the time to hop on.
Thanks, guys. Thanks for having us. Owen, Brendan, it was fantastic.
Appreciate you guys having us.